Hi everyone, Michael here from my sweet lab. The Dhandho Investor Summary, Chapter 15, Abhimanyu's Dilemma, The Art of Selling. This is a very important chapter. I would say one of the best chapters in this book. And if you're not going to read this book, I would highly recommend you to at least read this chapter because this chapter is all about the plan of exit, how you're going to exit. It's really, I mean, the way Mohnish structured this chapter it's brilliant. So I can't wait to share this. Let's get started. All right. Selling a stock is a more difficult decision than buying one. So having a strong framework will help in making the decision. Based on the ancient epic poem Mahabharata, Mohnish talked about how Abhimanyu died during the ancient war when he managed to penetrate in a spiral-like battle formation but failed to get out of the formation. The lesson from Abhimanyu's story is to have a crystal clear exit plan before we ever think about buying a stock. Before entering, always ask yourself, do you understand this business and is it within your circle of competence? Number 2, do you know what is the intrinsic value of this business and how it will change over the years confidently? Number 3, is the business priced at a large discount to its intrinsic value today and in 2 to 3 years? Over 50%? Number 4, are you willing to invest a large part of your net worth into this business? Number 5, is the downside minimal? Number 6, does the business have a moat? Number 7, is it run by able and honest managers? Look, this is an important checklist to buy a business. Now, what about the exit? Thanks, Mohnish, he has done it. Traversing the rings, Mohnish Pabrai used a gas station as a model to explain. To simplify, any stock that you buy cannot be sold at a loss within 2 to 3 years of buying it unless you can say with high certainty that the intrinsic value is less than the current price the market is offering. No matter what, you shouldn't sell a business if it has been less than 2 to 3 years since you bought. Number 2, you are unable to come up with a realistic intrinsic value with a very high degree of certainty. Number 3, present offered price is well below our conservative estimate of present intrinsic value. What if a stock can be sold at a loss within 2 to 3 years? What are the conditions for it? Number 1, able to estimate its present and future intrinsic value 2 to 3 years out with a very high degree of certainty. Number 2, the price offered is higher than the present or future estimated intrinsic value. Always remember Warren Buffett's 2 main rules. Rule number 1, never lose money. Rule number 2, never forget rule number 1. Real business changes takes time. 2 to 3 years works like magic. Joel Greenblatt stated in his book The Little Book That Beats the Market, called for all stocks to be held for exactly a year, especially deep value stocks, and you know nothing about the business. The 2 to 3 years rule is actually helping you to be patient because, as Munger said, you make the most money in waiting. Universal Stainless and Alloy Products. Mohnish bought this company investing 10% of the fund and made the money back with good returns by patiently waiting for 3 years despite the low dips and the industry affected as well, the whole industry. That patience paid him. Don't hesitate to take a realized loss once 3 years passed. They can shape you better. Exiting the Chakrayu. Chakrayu is the spiral formation. Within 3 years of buying, feel free to sell and exit if the intrinsic value and price converged and the gap narrows to under 10%. Sell once the market price exceeded intrinsic value unless for tax purposes you can wait longer to cover the cost. Now, how many simultaneous Chakrayu battles? Warren Buffett and Charlie Munger highlighted the benefits of concentrated equity ownership, especially with the famous quote by Buffett asking us to make investment decisions as you have a punch card with 20 holes in it and that's all you can have. He even said 20 is quite a lot too. In Mohnish words, the mantra is few bets, big bets, infrequent bets, all placed when the odds are overwhelmingly in your favor. Come on, guys. I reread this chapter again and again and again. It's really important to understand the importance of the exit, the timing when you should exit. So that's why you make money. I mean, you make money in waiting, of course. So what's the duration of the time that you're supposed to wait, and what are the indicators that you have to follow? So go through this chapter again. I'm going to reread it again. It's really important. Thanks, Mohnish. Thanks a lot. Thank you, guys, and thanks for listening. Do like us, do follow, do give your comments, do give feedback, and do subscribe. See you again on the next chapter, and I wish you my sweet luck.